So today what I want to do is briefly show you a really simple but such an effective strategy at reducing the taxation on retirement income in the early stages of retirement. Now this is different than the TFSA Maximizer Strategy, which is a lot more complicated, a lot more sophisticated, and really only reserved for people that have a significant amount of retirement savings. Usually 500,000, 750,000 to $1 million of RRSP assets where there's going to be substantial tax. But this is nonetheless more of an effective strategy that you would use up to age 71 or when you start to take substantial income. So we wanted to go through just at a high level. We won't get into a lot of the math details, but just to show you conceptually how this would work. And this is just a traditional RRSP or RRSP Meltdown strategy. So what we would have is you would normally have your RRSP, which is anything that you take out of your RRSP, you are going to pay tax. It's going to be 100% taxable, 100%. What conversely there is you can use a non-registered account. Now what's cool about the sophistication and the technology and the different type of investment instruments that we have and the different securities is more often than not we can get the income that comes out of this non-registered account for the first 10 to 15 years, not percentage, years, to be free of tax. It won't be exact. It's very difficult to have zero tax, but it is going to be next to zero. And worst case scenario, if you sold the entire amount, you are only going to pay tax on it at a capital gain. And this is through return of capital distributions and a whole bunch of other different kind of investment solutions that we would have. But that's not going to be the foray of what we're going to talk about today. So if you know that you can have 50% or less out of a non-registered savings, how would we be able to effectively get the retirement income over to the non-registered side versus the RRSP side? And this is really in essence what we do, is you actually borrow money to invest in the non-registered portfolio. So let's say that a client has $250,000 in their RRSP. What we would want to do is go $250,000 if there was that borrowing capacity or whatever number is suitable for each client and invest it into a non-registered portfolio. Why we would do that is because the interest that is paid when you borrow to invest is tax deductible. So now, because the interest is tax deductible, it would be, what you're doing is you're pulling out money out of the RRSP, which would normally be 100% taxable, and you're paying this tax deductible interest, which makes that withdrawal from the RRSP completely tax neutral. Why that's important is because let's consider even just a small, modest 6% growth rate on both sides. Well, if you don't have to service the interest here, maybe you're paying 3% interest, well then that 6% growth is completely net of cost, which means it's going to continue to compound. But remember that the majority, if not all of that return is going to come in the form of deferred gains or return of capital, which means that 6% now is completely different tax spectrum than what the RRSP is. So we'll go through further details and show the math on this in subsequent videos and maybe with a blog article that will show the actual calculations. But this is pretty basic. If you do this over a period of time, and even let's just say it's 6%, which means your money's going to double probably in about 10 years, maybe a little bit longer, called 12 years. Well, that $250,000 would now be very tax efficient if worst case scenario 50%. So we've in essence cut your tax in half. Plus, remember the RRSP, although we're making these withdrawals to make interest, it's still going to grow in value. And although it's taxed at 100%, you definitely want to have your RRSP grow in value. That's the biggest advantage of using an RRSP meltdown compared to the TFSA Maximizer Strategy up to retirement is because you continue to get compounding in both your RRSP and your non-registered. So pretty simple strategy to put your head around, but really all you're doing is you're just trying to find a way that you can have your assets grow in a non-registered manner, and the easiest way to do it is a borrow to invest strategy funded by RRSPs to pay the tax deductible interest.